All right, first rates. The market breadth is looking choco-block again in terms of advancing stocks, 1500 advancing versus 260 declines. The bank Nifty is off to a flat start, Nifty is off to a flat start, and the breadth is looking strong. If one really looks at the broader construct of the market, the broader construct of the market is that we are in for a decent start. Let's address the newsmakers now. You want to start first, you want to start with what's happening in Paytm. It has to be locked up. Quest Corp would be the other one. Dr. Reddy, Novartis. These are some of the newsmakers where I think the market action would be there, and I think it's unexpected. And the small cap I think is inching up higher, and that's up 3/4%, much higher than what the Nifty and the Sensex are. Aisha?
Okay, a lot of other stocks, PB Fintech, like we just flagged off, they've got an principal approval for a composite license. Paytm continues to be in the limelight, while PB Fintech is holding up 5.5%. Paytm as well it's a very, very minute move though for the index, but clearly the action is outside the index. MCX, let's look at what that stock is up to. UBS has increased their target price all the way up to 4,300 now, and MCX holding up 1.5% or so. Quest Corp, they've announced a three-way split, so look out for what that stock as well is up to. And Novartis India as well, along with that Balrampur Chini, because they're looking to now manufacture chemicals for bioplastics, and it's a sizable investment as well that they've announced, 3.5% higher for Balrampur Chini as we speak right now. Sula, that's the other one which is in focus. Remember, we reported over the weekend that there's a sizable block deal which is likely to take place, and it seems like it's already happened. 5.5% is the downtick that you're seeing on that stock. And then, of course, railway defense, irrespective of the exuberance in the valuations, the run-up in the stocks, the order flow as well continues as strong. So Titagarh Rail has also got an order, RVNL got an order over the weekend, and the defense stocks continue in focus considering the DSC has now cleared capital acquisition proposals worth in excess of 84,000 crore rupees. So that pocket of the market as well is looking lively. For the benchmarks though, it's a pretty lackluster day. There are no sharp cuts, but most of these stocks are in the red as we speak. Hindustan, Axis, M&M, the big star performer from last week, that's taking a little bit of a breather. Hindustan, etc. as well are in the red as we speak, and so is the technology pack. What is HDFC Bank up to, considering after hitting its 52-week low just last week, you did see a fair amount of pickup in the stock. It's finally back to 1400 plus levels. Not a material move on the stock though this morning. A couple of buzzers from Friday, Ipca Laboratories, Glenmark, Biocon, some of these pharma names as well were pretty lively. So let's just take a look at some of those names. Pretty lackluster all across. Let me quickly take it across to Naresh, get in his first trades this morning first.
So continue like IDFC First Bank for a bounce back trade towards 90, buy at current levels as well as on dips.
Okay, Rudra, let's very quickly have your first trades too.
HDFC Bank, yes, after a long time, the stock has made that bottom formation. So HDFC Bank is a buy.
Right. Okay, that's that on the market. Let's now shift focus to what the market ahead looks like, not 1 or 2 days, but perhaps the next decadal move or view on the markets. And we've been cribbing about as to how FIIs have completely eluded us. Well, one FII definitely hasn't, with one of their largest exposures to India. Let me welcome on board Vikas Prasad, Portfolio Manager, Asia Equities M&G Investments, and with him, Deepika Mundra, Director M&G, making her debut. Hi, both of you. Good to have you in the studios. So Vikas, clearly you guys are one of the camp who hasn't eluded India, right? You've been investing all across. But what's keeping your other peers out of India?
I think it's many issues, and it's wonderful that we, after all these years, can continue to talk about these things. It's odd that we still get the same questions. You could have asked me this 5 years ago, 10 years ago. Why are FIIs not more heavily involved in India? I think there are many reasons. I think many of them are backward looking. And if you look at the move India has had, in absolute terms relative to other markets, people think, well, maybe we can find better value elsewhere. Our view is that is not the case. I think this is a great time to be investing in India. In fact, over the last 2 years, we have increased our allocation to India by more than any other market, except for Japan and Greater China. Those three have been large allocations for us. We see a lot of opportunities beyond the index. You were just talking about the action is outside the index. We see the same thing. The leaders of yesterday are not the leaders of today. Today's leaders probably won't be the leaders of tomorrow. There's a lot to look at in India, and so we're very excited. I think it's too much fear about valuation, and we'll come back to that, I think. Too much fear about how much things have gone up, and then too much hope that other markets will deliver better returns.
Let's talk about the construct. Now, if I look at India for next 5 years, 10 years, it stands out. I mean, India's story needs no introduction. Everybody knows that, look, this is the place you want to be in. So, because my question is that when you look at the valuation construct, investing is about buying silver, gold at the price of silver. In India, you're buying pretty much gold at the price of gold. So, where will the upside come from?
I think the upside comes through time horizon arbitrage, for one. The upside comes through doing a lot of work and having the conviction that if something goes up 20, 30, 50%, or goes up 100%, that you hold on, you don't take profits, you don't sell too early. The trick in other markets is buying too early and maybe selling too late. In India, the trick is selling too early. And we've learned that over time. If you look at our portfolio broadly, we have owned the same names for months and quarters and years now. Defense is something that was just on the air. That's something that we have exposure to despite the rally. Two-wheelers and autos, some of the PSUs, we continue to hold these because we think the prospective returns continue to be high. India might be pricey in some lenses, but it's pricey because that's where the growth is, that's where the returns are, that's where the money is. And so that's why we come back to this market again and again.
So Deepika, where do you find value on the table right now? Looking at the run-up, which some of the pockets that Vikas just highlighted, it's already taken place. And there's so much fear and panic around the valuations, the steep run-up in the stock prices already. Where would you say for the next 5 years, you would say that, I'm still willing to pay this price?
Sure. So just to add to what Vikas is saying is to be patient and not to sell too early. So some of those sectors which we think will see some months of disruption, we would still continue to invest in those. These are the cyclical ones, right? Engineering and construction, commercial vehicles, cement. Few months of disruption does not disrupt the long-term story. On the other hand, we think where companies have good assets which can generate cash flows over a very long period of time, difficult to replace assets, so hotels, airports, REITs, so not necessarily all in the benchmark, but good assets which can see strong cash flow potential over the long term. Autos, we already mentioned, that's something where we are still bullish on. Two-wheelers more than four-wheelers. We see multiple themes playing out in that space, whether it is premiumization in terms of consumer choices, transition to electric, and the cyclical recovery, which is still pending since 2019. So these are the few spaces we think we're still bullish on, irrespective of where prices have gone up, and keeping valuations in mind as well.
When you say you like cyclicals, the reason why they're called cyclicals is because they follow a cycle, right?
Yeah.
There would be good time, there would be bad time, there would be great time, and there would be very bad time. Where are we in this cyclicality of cyclicals?
Sure. So one is, we've already seen the very bad time, right? Almost a decade of nothing happening in a lot of the cyclical stocks. So we've already been through that pain period. We've seen 2 or 3 consecutive very strong budgets. And now suddenly we see people asking us questions. This budget is not as big as what it was last 2 years around. But still there is growth. Private sector capex has barely taken off. We haven't seen any of that. If you look at corporate leverage, it's at all-time lows, right? So companies are clearly geared to invest for the future. So that's why we think that the cyclical recovery, yes, it's partially already taken place, but there's still legs to go on that front.
Because there's a term which you used in your last interaction with Aisha, and I shamelessly used it. Can you guess that term?
He made a show on it. He just didn't use that.
Is this
I made a show on
the
it.
class of 21, right?
Yes, actually shamelessly
I knew
made
this
a
was
show
coming.
on it.
I knew this was coming. Yeah.
No, I mean, I made a show on it.
Yeah, I saw
And
it. I saw
everybody
it.
who got listed in class of 21.
Yeah.
I don't remember what was my class also. It's been 30 years now. Okay, class of 21 has done well.
Yes.
Excepting Paytm.
Even Nykaa actually.
Even Nykaa, yeah. But that category in a sense has made a comeback. Earnings are there, visibility is there. Promoters are now realizing that think profits, don't think growth.
Right.
Now that's the bet on India.
Yes.
Are you looking at that spot?
At the recent IPOs you're talking about?
I mean, I'm just talking about the class of 21.
The class of 21, yes. So I did mention that we have not much exposure sum.
Yeah.
So fortunately, that sum has done well. But largely, we still remain largely uninvested in the IPOs from that year. But I think collectively, they have demonstrated their intelligence. They've gotten better. The corporate governance is getting better. The focus on profits is getting better or more acute. And the market is rewarding them for that. I think the lessons that they have learned either intentionally or unintentionally, will benefit the class of 24 IPOs, the class of 25 IPOs, which I think we are more excited about. India is the most active market for IPOs in the world over the last 12 to 18 months. I think that will continue. And I think they will all benefit from the lessons learned from 2021. What's interesting about those companies is we didn't have very many broken or stressed business models. It was the pricing of those IPOs. And we invest based on the prospective returns, right? We can buy a good business, but if it's at the wrong price, we'll wait. And in some cases, we waited. And over time, as a result of that conversation, I also went back and looked at all of those. And I watched every one of those episodes. And it was a reminder that you need to be looking at these again, anew.
Some of those companies have done well. I guess the realization came in that when you are in the listed market, you got to play with the rules of the listed market. When in private market, you got to play very differently.
Yes.
You can't confuse, and that realization has kicked in. So Deepika, whether it's two-wheelers or whether it's cyclicals or whether it's defense, you're betting on a lot of recovery in the economy.
Yes.
Some would argue and say that the deep-rooted recovery has already happened. It's no longer a V. The recovery has played out very well in all the sectors. So then why are you still betting on the recovery themes, whether it is infrastructure or whether it is cement or whether it is two-wheelers?
Sure. So each of them have different reasons. Not all of it is the same. If you had to think about construction or cement, that goes sort of hand in hand in some cases. One, India is still building, right? Whether we're seeing railways, roads, airports, any type of infrastructure, you are seeing activity over there on the ground, and you're seeing the government increasingly still allocate more money to those sectors. Secondly, like I mentioned earlier, private capex has done barely anything. We hardly have seen any signs of companies announcing very large projects. Capacity utilization in the system is well above 70%. You are going to see that take place in some form or shape or the other. It might not necessarily be identical to the previous cycle. You may not see hundreds of PPP road projects, but it will happen in other shapes and forms. So we think that will continue. In terms of two-wheelers or the recovery over there, we're still not back to 2019 volumes. You have a replacement cycle which is yet to kick in, which got depressed during the entire COVID period. Secondly, you have a lot of, you see the K-shaped recovery, right? It's playing out in multiple sectors. It will play out in some form in the two-wheelers itself. And then you have the transition to electric, which is adding to volume. So that will go through its own challenges depending on charging infrastructure, subsidies, how those pan out. So there will be ups and downs on that front. But 5 years later or 3 years later, will we see better outlook for that sector? For sure.
Because at the crux of all of this boom is going to be financials, right? And private banks forming a large chunk of that. What explains the underperformance? I mean, you could select, you could exclude ICICI Bank and select few of the names, but the larger ones.
I think the magnitude of the underperformance has surprised us a little bit year to date. At the start of this year, end of last year, just like we talked about last year in February, at the start of the year, we had reduced some of our private sector holdings. We have had enough of them, the private banks, this year. We have had some exposure. It's been large enough to be a little annoying, but not large enough to be hurtful. Okay. In fact, over the last couple of weeks, we have incrementally added some private bank exposure because if you look at it relative to the PSUs, and I think the PSUs in general across sectors are doing well for many reasons, but in the banks in particular, things do look a little distorted. So again, on our time horizon, and given that we weren't full up on the banks already to start the year, we have incrementally added some. Now to answer your question, I think it's an issue of communication. It's an issue of liquidity in the system, but that's all known. I also think it's a direct function of all the other opportunities that we're seeing. Coming back to your point on where the action is, whether it's in the index or beyond the index, look at the breadth that the Indian market has. We touched on the IPOs, most active market for IPOs in the world last year. If you look at the listed universe in India today, you now have 6,000 listed companies, and about 1,500 have a market cap over $100 million. Now that's an arbitrary number, but it just shows you that number a year ago was 1,000 companies. Now it's 1,500. That liquidity, the breadth, the depth is only going to improve. And this is why when we were thinking, what do we want to talk about? What message do we want to leave viewers with? We wanted to say, like us, we have had cash at very low levels for the past year. We've been fully deployed in India. That has been helpful. We're thinking on the long term, not the short term. We're thinking that this is a developed market. You look at India today, on what definition is this an emerging market? One of the largest markets in the world, one of the largest economies in the world, thousands of listed companies. The quality of the conversations that we now have with companies is so different from 10, 15, 20 years ago. It's about capital allocation. It's about thoughtful growth, profitable growth. These are all hallmarks of a developed market. So we have stopped calling India an emerging market. It has emerged. How much more do you want it to emerge? keep your cash levels low, बढ़ो देश के साथ, right? Stay invested.
Yeah.
To say that again?
It was on my coffee mug this morning.
Rise with India.
Yeah, Rise
That's
with
what
India.
it
Yeah,
said.
that's the way it
No,
is.
and Deepika, you've been researching some of these IPOs, right? The class of 2023, and you've come up with some really bright names from what I hear. Pedigree names, is that what gives you comfort?
Pedigree, but also in terms of track record, right? It might not necessarily be a very well-known name, but something that has reasonable track record will give you more comfort at these index levels. Secondly, the way we evaluate stocks, right, where we think that the intrinsic value is higher than what the IPO is coming at. So that's the fundamental thing to begin with. So just the company deleveraging or just the promoter looking to sort of do a benchmark valuation for the company, that's not the main criteria. Where we genuinely find that there is a gap between the intrinsic value and where the IPO is coming at is what we have participated in the class of 2023.
Right. So which six sectors, I know you can't talk stocks and you can't mention those IPOs, but which sectors are of interest within the recently listed universe?
Sure. So this would be in defense, healthcare, in the technology space. These would be the 2 or 3 spaces that we looked at last year in terms of IPOs.
Because, markets, they always follow a style. There's a time when dividend investing will do well. There's a time growth does well. There's a time value does well. Last 18 months, growth's done well in India, whether it is, some of the defense, cyclicals, or for that matter, infrastructure names. And value has made a comeback, which is PSU. It's a rarity. Why is that we are seeing a rising tide phenomenon?
I think before we look abroad, you look internally and you look at the retail interest, how the financialization of savings is happening here in India. Markets, investors, retail investors are now taking money from other sources and putting it into the market. And I think that is driving it. You have a lot of people focused on this market. You have China on one hand that has gone from being a specialist market to a generalist market, and I think it's back to being now a specialist market. India's following a different direction. We started, historically, India's been a specialist market. You have people either based here onshore or who are from here focused on this market, but you now have people being reallocated from other markets, China in particular focused on India, and you have a broader, deeper set of companies meeting up with a broader, deeper set of investors. So I think that's it. And if you look on a long-term view, there's still a lot of value in this market. If you look not at a 1-year forward PE, but if you play that it's a snapshot, right? You play that movie forward, the PEs fall pretty quickly in India. If you look, maybe this is hindsight, but the last 15 years, best performing market in the world, would you not say that India was then the cheapest market in the world 15 years ago? Because it's the one that has risen most and converged to intrinsic value, I would say on that time horizon, India is still the cheapest market in the world, which is why we're here, and which is why we have allocated our capital so assertively to this market, and why we're canvassing the whole market for ideas, because there is a lot of value here still.
So 3 years out, let me split the next question in 3 frameworks. One is a tactical trade, which is that where you're hunting for next 18 months to 24 months. Then you got to look at 5-year themes where you are looking at perhaps value migration. And then you're looking at 10-year plus. We're talking about decades here, which is like, okay, 10-year plus, this theme will do well. Indian middle class in 10 years will do well. Banks will do well. So if you divide your portfolio in 3 parts, less than 2 years, about 5 years and 10-year plus, how would you bracket it?
I'm glad I have an advanced degree to just picture through this matrix. But in the short term, I think it's tempting to look at the mega caps, the relative underperformance. We have at the margin increased our exposure a little bit there. But I still think whether it's 2 years, 5 years, 10 years, most of the themes will be pretty consistent. The rise of the consumer, what we thought initially was a K-shaped recovery, seems to be turning into a K-shaped economy in many sectors. Okay. So hotels, two-wheelers, cars, car dealerships, listed car dealerships, all that, you broaden out, you draw concentric circles, you find more and more opportunities. I think if you want to get more specific, packaged foods, for example. Just this month, we have spoken to a couple companies based in Andhra, packaged food dairy companies, small cap, professional management teams, very focused on profitable growth. Every city we go to, every sector we look at, you are finding companies in the $100 million to $2 billion market cap range that will just compound over time. If you look today at some of the companies that are $50 to $100 billion market caps, they were $500 million to $2 billion when I moved to Asia in 2005. That's going to happen again in India, then it'll happen again and again and again.
But isn't that worrisome that it's such a steep, evident K-shaped recovery?
It is, well, it's worrisome on multiple levels. It's worrisome for the broader populace. It's worrisome for investors in the short to intermediate term. Because if you look back, 2009 was our first conversation like this, and we were just coming out of the GFC. There was so much uncertainty. There was uncertainty around who would be in the Prime Minister's office, May 2009. There was uncertainty around the economy, local and global, what happens to oil, what happens to interest rates. Out of that came a huge market rally. There seems to be not very much uncertainty now. We're speaking in relatively confident terms that for the next few years, India is well placed. Usually following that is what Nikunj is hinting at, right? Usually following that is a period of turbulence, subpar returns. But I think in India, the growth will offset that. And we're pretty well placed here. But if you look at some of these sectors, some of the market cap accretion that you've seen in the retail sector, in some of these PSUs, it's not, we say that we're focused on the long term, but some of this multiple inflation has been so rapid and so significant that it's time to take pause and perhaps look elsewhere.
Because the centerpiece for valuation is always interest rates. Like Buffett says that they act like gravity if they go higher. I'm assuming that interest rates are not going to come down in a hurry, which is what it is evident. Inflation is going to remain elevated with a downward bias. So if interest rate curve is not going to be changing in a meaningful manner, at least in India, what will that do to forward multiples and what will that do to valuations?
So typically when we're looking at stocks, we're always looking more bottom up. Our construct is not always macro based. So when you're looking at high interest rates, we're looking at companies which have pricing power, that are able to pass on higher costs or higher cost of capital to either customers or just through the system. So that's our thought process. Also, we're not betting on interest rates coming off, and our portfolio is not constructed in that way that interest rates will come off, so X% of the portfolio will benefit from that. That's not the way we think about it.
Because you've been talking about China plus one and how you don't buy that thesis right now. Enlighten our viewers about it.
Well, I think it's broader than that. The world is so focused on China plus one. Companies are so focused on China plus one. What they also need to focus on is one plus India. So whatever market that you are selling into, you have to consider the Indian consumer, the Indian government as a potential consumer for you. If you're looking at your supply chain, you have to consider whatever market that you're focused on as your manufacturing hub to look at India as well. 18 months ago, I confess, I was not super bulled up on this Make in India theme on the short term. When Apple said that they were going to have 10 to 12% of their manufacturing capacity in India within X number of months, I thought, okay, let's give them some time. They proved it, other companies have proved it. What is interesting is there's some news today about one of the two-wheeler companies here and a Japanese company taking a stake in the EV company, right? I was in Japan last month, 13 meetings. India came up in every single one of them. I brought it up in 2. The companies brought it up in 11. They wanted to learn from us. They're sending people here. They're making investments here. And they are probably, the Japanese companies are probably ahead of most companies around the world. But that led me to think that you really have to think about not just China plus one, but one plus India. If you're selling into a country, add India. If you're making in another country, you have to think about India now, which I've come around to. I was not a believer in a big way just a couple of years ago.
But your exposure is still larger to countries like Japan and Greater China.
Today, yes, but India's catching up. Partly organically, given how the markets are going, but also because of our capital allocation. We're making active decisions there. Now, as you know, we invest globally. I think for an investor who can invest across the region and around the world, I get it why on a 1 to 2 year view, today you might be slightly underweight relative to other markets that you're seeing. But in the very long-term view, it's hard to be short this market, which is why we've tried not to be in our India dedicated funds. Our cash has been low. We've been fully deployed. We're relatively nimble. The good thing is there's so many options now that are liquid enough that we can move the portfolio around if necessary. But we like the portfolio as it is.
The mainland China bullish call, is it purely valuation basis because they've been so down and out, or are you actually seeing those triggers and green shoots in China and in the economy?
So this is the right question because people think of India as an absolute return market, but it's hard to get relative performance. People think of China as a market where you can be a relative outperformer, maybe just have some cash or you're in defensive names, but you can't generate absolute returns. What we have found is that there are absolute returns to have in China. Markets follow earnings. This is what Nikunj says all the time, right? Stocks follow earnings. And we have a lot of opportunities on the ground in China in the tech hardware space, semiconductors, factory automation, in the broader EV supply chain, in the local consumer. If you look at the recent earnings release from Starbucks, I think about at the 10 or 11 minute mark, they talk about losing some share. There's a transition going on in the market, and local companies are taking share. It's because they understand their consumer, they're incorporating technology, and they're taking the market. That's going to happen in vertical after vertical, in industry after industry. So yes, it is partly valuation, and the fact that a market has just halved in 2 years. The Hang Seng has halved in 2 years.
Yeah.
So then naturally that draws our attention. But there's earnings growth there as well. And when you have what we think is earnings growth at a time when valuations are depressed, that sets it up well for prospective returns.
I'll ask a very basic question to Deepika. I'm asking this perhaps to everybody. Markets, they follow cycle. Bull market and bear market, they coexist. Looking at your understanding of the market and the valuation, you don't think we are in any kind of a bubble, at least in India?
That's a great question and $1 million question, right? We never know when we're in a bubble, but we don't think so. So as long as, like Vikas also said, we have earnings growth, we're okay. We are not seeing multiple earning downgrades. You're seeing it in some spaces for sure, but you're not seeing it across the board. So as long as earnings growth is there, as long as we're not building sky high estimates across every single company that we have in the portfolio and then giving them top of the cycle multiples, we're still okay. So when we evaluate stock by stock, go through the entire portfolio, we still don't think we're there yet. So not a bubble.
But are there pockets which are just about reaching there, which are on your watch list?
Yeah, like we said, we have to be cautious in some of the spaces where stocks have just multiplied very rapidly in a matter of even a month or 2 months. And in those spaces, we would think that, like PSUs, for instance, we'd want to be very careful on where execution is actually panning out versus just orders coming in. We've seen this cycle in the past. It starts with news flow around capex cycle picking up, then the orders come, and then they come in spades. But then we need the execution to follow and the working capital to follow. So we wouldn't want to ignore those facts as in how they pan out. We'd want to be careful on that front. So I think some of these stocks which have multiplied, I think in a 2-3 month time frame, we'd be a little bit more cautious on that front.
Can I add something on that?
Yeah.
I think a good example is EMS. So at the start of this month, we exited our last remaining exposure for now in the EMS sector. Because this is a bet that we had made early last year, Q1, Q2 last year. Starting to get familiar with it.
What is the next bet? Let's talk about it. EMS you've exited.
Yeah, well, actually, it could be EMS again. On this trip that I'm about to embark on with Deepika, we're meeting a series of EMS companies. There's a very long tail to growth there. So it could be that. Hospitals has done better than we expected, so we've taken a little bit off the private sector hospitals as well. Ask me at the end of this trip, and then I'll tell you what answers we
Which are
found.
the companies
You're
you're meeting?
coming
That's
back
a hint.
again to the studio.
Well,
book that appointment.
the auto ancillaries, two-wheelers, EMS. Even I was surprised, having looked at auto ancillaries in India for so long, the auto sector in India for so long, how deep that universe is. And when companies in Japan are asking us about acquisition targets in that space here, or collaboration opportunities here, people are looking at it, and we have not spent enough time. We have exposure, but we have not spent enough time. So I think there's a lot still to do there.
Deepika, thank you very much for joining us. I hope you enjoyed your first interaction with ET now. Look
Very
forward
much.
to
Thank you so much.
appreciate, sir. Do you remember our first interaction, 2010? You were different. I was different.
Yeah, I saw that video a week back.
So this is called wisdom. That's what it's called. All the cycles that we've had.
Yes.
We get to get there.
Yeah.
Experience.
It's experience, wisdom. Yeah.
It's not stress, right?
No, it's not stress.
As long as in India, there's no stress.
No. But it's such a pleasure to be here with both of you. Thank you very much for having us.
Thank you so
very
much.
Yeah. Thank you. All right, Gautam Dugar joins us, Head of Research Institutional Equities with Motilal Oswal. Gautam, I'm not sure if you heard our conversation with Vikas and Deepika, but in case you don't serve them well, they're bullish on India. You want to call them after this to make them your prospective client.
Sure, Nikunj. Thanks for the lead.
What are you telling your clients right now? I mean, there's a whole narrative which has started again that markets are expensive, valuations are stretched, there is too much of optimism, and it is retail which is driving flows, not earnings and macros.
Good morning, Nikunj. Actually, I have a very contrary view. It's the earnings which is driving the flow and earnings which is driving the markets. Let me explain that in a bit. Nikunj, 2010 to 20, when Nifty earnings compounded at 6.5%, Nifty gave you 8.4 or 8.5% compounding. So broadly, the earnings converged with the markets in that 10-year period. Last 4 years, between FY20 to 24, now that 9 months of FY24 are behind, we can say with reasonable certainty that we know a thing or two about FY24 earnings now. FY20 to 24 earnings are compounding at 22%, Nikunj, on Nifty. The Nifty profit pool in FY20 was 3.5 lakh crores, so 3.5 trillion. This year, we will end at 6.64 trillion. So that's a 22% compounding. Our own broader coverage universe of Motilal Oswal, 270 stocks, the profit pool was 4 lakh crores in FY20. We will end FY24 with almost 10.96 trillion, so which is 11 lakh crores, which is a compounding of 27%. What is the Nifty compounded at in the last 4 years? 22%, right? So markets have kept pace with earnings, which is why even at 22,000, the 1 year forward price to earning ratio of Nifty is about 20 times. The 10-year average is 19.5 times. So we are well within our long period average range. Where things are a little bit expensive is clearly mid and small cap. The mid cap index is trading at a 30-40% premium to Nifty. Now, obviously, there are pockets in mid caps where things have run ahead of themselves, earnings need to catch up. But the flows have also played a part here, Nikunj. CY22, the domestic flows were $32 billion. CY23, it is about $22 billion. So in 2 years, CY22 plus CY23, you received $54 billion of domestic institutional flows. And January also about $3 billion, right? In the same intervening 25-month period, FII flows were very flattish because in CY22, they sold somewhere about $17 billion. And in CY23, they bought $22 billion. So that is about $5 billion of inflow. But in the first month of CY24, they again sold close to $3 billion. So it's been very flattish in terms of FII flows in the last 25 months, whereas domestic flows have been about $55 billion. Now, large part of the domestic flows, if you look at the segregation, the mid and small cap oriented schemes have received good inflows. And there also the earnings have been decent. But as it usually happens in a bull market, sometimes some sectors run ahead of themselves. And then after a period of time, they need to cool off. But I clearly believe that the bull run, which we are in the midst of, is led by corporate earnings. Very few markets have a confluence of good macro and micro today that India enjoys globally. Now, 7% GDP, 5% inflation, current account under control, crude prices behaving, 10-year GSEC at 7.2, and currency stable. And on top of that, such a resilient corporate earnings. I don't think this combo is available in many markets or markets with a size of 4.4 trillion market cap.
I completely endorse that we are in for a Mahakumbh of Capex. We are in for a binge in terms of per capita, and we are in for a huge expansion in terms of where the new sectors are getting created. So I don't want to challenge your thought here because everybody endorses it. But I'm simply curious here to understand that what could go wrong? I mean, it's also, investing is also about understanding risk. So what could be the risk, barring few global events which we don't know of? What could be the risk to the earnings? For example, I'm breaking it for our viewers. Inflation turned out to be a risk in 2022 and 23. What could be the risk now?
So Nikunj, the big risk always is in the unknown, right? Any risk which you can forecast gets discounted by markets very quickly. Be it a crude oil prices, direction of interest rates, GDP slowing down a little bit here or there, or corporate earnings missing a quarter or two. That never creates a very durable corrections in the equity markets. Markets correct in a durable fashion with big magnitude only when an unknown risk hits you. Like COVID was unforecastable. Taper tantrum was also unforecastable in 2012-13. Similarly, in 2017-18, the March 2018, the NBFC crisis, the ILFS event, nobody could forecast that. So I would think that is one of the most important elements to contend with when you are navigating through such a roaring bull market. That risk can come from any place, and the biggest risk is in the unknown. Now, what are the known risks? The obvious risk is we are heading into an election season, which has a significant bearing on policy implications. Market is largely discounting political continuity after the round of state elections that we saw in December. That is why suddenly in the month of December, you saw $8 billion of inflows, Nifty giving you 8% return in a month. So by and large, most of the pre-poll surveys, including Times Now, your own group, last week they came out with a survey predicting 336 for NDA. Then another survey predicted 366. So political continuity is well discounted. If for whatever reasons, the election outcome is not to the market's liking, that could be a very big risk factor in the near term. That aside, the direction of interest rates, people are discounting in the next 6-9 months, interest rate cycle will turn. If for whatever reason that doesn't turn, that could also act as a big risk factor. And last risk that I want to highlight is that a lot of investors who have entered in the last 4 years, March 20, you had 35 million demat accounts. March 24, as we approach, right now we are sitting at 145 million demat accounts. So whoever has entered in this market in the last 4 years has not seen any correction or any durable, a prolonged period of zero or no returns. Therefore, there is a little bit of complacency in that segment of the market, which sometimes acts as a very big risk. And a market has its own ways to inject an element of reality every now and then.
Use HDFC Bank and SBI as an indicator of economy, Gautam, because they are, between them, the market share I think is more than 35-40%. HDFC Bank is talking about growth slowing down. SBI is talking about growth anywhere between 13 to 15%. So aren't these early telltale signs that the base effect has kicked in?
Nikunj, on the contrary, I believe if we manage to keep growth at 15% at a system level for credit growth, it's a very strong number. Because do remember, we are not going to grow at 20% credit growth like we saw in 2003 to 10. The size of the economy, the size of the credit, overall credit in the economy was very different then. So you compounded at 20% credit growth in that era. Second, you today have a very important legislation in place, which is Insolvency and Bankruptcy Code. So today you don't have a situation where every promoter, every company walking into a branch of a bank and taking a loan for capex. Today's capex is very different than the capex cycle you saw in 2003 to 10 period. It's very niche. It's focused on very selective segments. And that's a good thing in my view, because even if the growth at the credit, systemic credit level is a few percentage point lower, but it is very calibrated and very prudent. And it doesn't induce any big asset quality shock that we've seen in the early part of this millennium. My point is, if we manage to grow at 14-15% credit in the economy for next 2-3 years, the good quality banks can easily compound their earnings in 17 to 20%. But to your specific point on HDFC Bank and SBI, for last 2 years, we've been having a significant overweight on PSU banks. The two big stocks in our model portfolio have been SBI and Bank of Baroda. And this is the first quarter of the results season, first quarter where in banking, we have seen PSU banks outperforming private banks on earnings. First quarter where I have seen private banks earnings getting cut and PSU banks earnings getting upgraded. And all said and done, despite the recent run-up, the PSU banks are still trading at 0.9 to 1.2 price to book. I think there is a lot more steam left in the PSU bank cycle. And at the private bank level, I think while valuations have derated a lot, given the ownership in some of those names, there is a possibility that while earnings growth and fundamentals look very strong, the market cap compounding may lag a little bit more.
You've seen big upgrades, and if I look at your note as well, in autos, that's a meaningful sector. It's a very large contributor. How should one look into this sudden uptick in demand in autos? Do you think it will sustain? Do you think one should build up on this auto theme, whether it is export to domestic or EV now?
So Nikunj, let me give you one context on auto. Between FY18 to FY23, the auto earnings were absolutely flat in Nifty at about 30,000 crores. The FY18 was the earlier peak when auto earnings in Nifty, were 30,000 crores. In an FY23 also, it was about 28,000 crores. FY24 is the first year of a big auto earnings growth, right? We have seen auto earnings doubling in FY24, which is why a year and a half back, we had gone overweight on auto from underweight. Having said that, now we are entering FY25, where you have to contend with a very high base, and management commentaries on auto has been very mixed. Nothing taking away from the great delivery for last 5 quarters in a row. In fact, I would go one step ahead and say auto has been the best performing sector on earnings in our coverage universe 5th quarter in a row. In fact, for this quarter also, we have seen a 60% earnings growth, while our expectation was 34%. And as you rightly mentioned, it is a sector which has seen the highest quantum of earnings upgrade at about 7% within Nifty. So much so that all the 6 Nifty auto companies have posted numbers which are either in line or ahead of expectations. That being said, I must also point out that FY25 can be the year of normalization for auto. While it will remain healthy, but the quantum of growth that you might see will not be similar to what you have seen in FY24 because the outlook on various segments as far as volume is concerned is very modest. Anywhere between 4 to 8% volume growth. CV, a lot of managements have highlighted that the growth is moderating there. The best performing segment will be two-wheeler insofar as volumes are concerned. And then you are also contending with a high base of margin in FY25. So our expectation for FY25 earnings growth is about 10 to 15%, and which is why in the January revision of our model portfolio, we have again reduced auto from overweight to now neutral.
Hi, wanted to understand your outlook when it comes to the IT sector as well, because in Q3 we clearly did see that weakness in a lot of the key verticals as well. Going in, do you believe that the softness is going to persist when it comes to key verticals and geographies?
Yeah, I mean, if you go by the management commentaries of last 9 months, you have seen a situation where for 2 or 3 quarters in a row, we have seen guidances getting revised downwards by some of the large companies. Second, the expectations are very muted. In fact, if I were to talk about the current quarter, we were expecting flat earnings, and flat earnings is what we got. So they met our muted expectations, but the commentary on demand, the discretionary spending, decision-making cycles, net hiring. I mean, this quarter we have seen net hiring number at a negative 16,000, which was negative 18,000 in second quarter. So that is giving you some semblance of idea as to what the future holds, at least in the short term. But the business can remain slightly more challenged in the short term, but stock prices are now factoring that in, which is why if you look at the last 6 to 9 months, the IT sector has not corrected much. In fact, we've written multiple notes on banks versus IT as a comparison on strategy last year. And we have seen that for 12 years in a row now, the banks and IT, the relative alpha between these two sectors, the divergence is huge. On an average, there is a 35 to 37% alpha. So basically, if you have to take one call right at the beginning of the year, it better be between banks and IT. In fact, CY23, if you see, despite all the narrative about IT slowing down, etc., IT index gave you 24% return. Bank index gave you 12% return, and Nifty was up 20%. So IT has not only outperformed banks, it's outperformed the Nifty as well. I do expect the mid-cap IT to now sort of catch up with the earnings because the valuation premium over the large-cap IT has gone up significantly. And there is a possibility that you might see continued strong performance of mid-cap IT, but the stock prices may lag a little bit now to allow the earnings to sort of, to allow the valuations to sort of catch up. Whereas large-cap, we find risk-reward more attractive. So while we have an overall underweight stance on IT, within that, all our allocation is currently drifted towards large caps, with SL Tech being our top idea.
Okay, Gautam, thanks very much for breaking it down for us and giving us a 360-degree view of the overall earnings as well as outlook on the markets as a whole. Time to move on then, and let's put the spotlight on Sula Vineyards. Lots to chat about with respect to the block deal buzz, the Q3 numbers, as well as the premium segment growth. And Rajiv Samant is the promoter, managing director and CEO here joining in on the show to chat about just that. Thank you so much for joining us. Just to begin with, I'm going to start off with the news because they did have a block deal of about nearly 12% equity changing hands. There is a belief that it was Veril Invest Asia that was one of the sellers. Any more details that you can sell with respect to the other seller? Who is the buyer? Are there multiple buyers?
Absolutely. So let me talk about Veril Invest, please. Good morning to you. Veril Invest has been our private equity partner and associate now since almost 15 years. So it was time for them to get off. You know, most private equities stay on board a company for maybe 5 to 7 years. In this case, it's been an amazing long-term association, and they had come to the end of their journey in, any way you can look at it. So, with great mutual respect and appreciation, we've shaken hands and they have exited their final residual stake this morning. And that was about 8.5% of our shares changing hands. I must say that at this point, I don't have visibility for you on who was the other person who let go of some shares. I think we'll have a little bit more visibility a little bit later in the day. Most probably it was another one of our investors. You know, it's a good time to say that all our investors till date have always been really happy with their time at Sula and with their exits.
Yeah. Just wanted to ask whether or not you can divulge maybe a little more details as well as to whether or not the stake has been bought by Mr. R.K. Damani.
I don't have that information yet. I do believe that there are several long investors, respected mutual funds, sovereign wealth funds, etc., who have bought the World Invest stake. I am not aware yet of Mr. Damani's name. I must be very clear. Some of our existing investors and a few new investors, well-known mutual funds, those are the names that I have so far.
So are the PE exits done, or there could be more supply in coming quarters?
This was by far the largest PE. The others, there are a couple of small PEs, you know, with meaningless stakes. You can say maybe 1%, etc. Let's not forget that World Invest at one point just before IPO was close to 50% of Sula. They sold about half their stake in the IPO, and then out of their remaining stake, they sold a part in August, and now this is it. So that's it. The PE overhang to our stock, you can say, is now done.
And just to get it absolutely clear, what would be World Invest ownership now in Sula after this?
0. That would be their ownership.
I like that action.
0. And today, now our second biggest shareholder after myself, after the promoter family, is now HDFC Mutual Fund. Some of our others that have large holdings, you have Quant Mutual Fund, you have ADIA, the sovereign wealth fund of Abu Dhabi. These are some of our other large investors.
Investors also. Big HNI investors who own the company. It's in public domain. That you can share with us.
The HNI, no, I must say that apart from Rajiv Samant and family, you don't have today very large ones. I must say I'm very unaware of this news and this question that your co-anchor has asked me about Mr. Damani. I'm not aware at this point. More details will come out later on in the day.
Being frank and honest, but you'll also appreciate that our job was perhaps to address the curiosity which was there on the research desk. Pata lagao kisne share kharida hai. So I'll move away from the stake sale. And talk about business. In my book, the year gone by, or which is still on, was a tough year largely because of one factor which markets don't talk about it, which is that we had an erratic monsoon. If things normalize this year, if they do, what kind of change it will have for Sula? A bad year, you clock double-digit growth. In a normal year, what will happen?
You are being overly generous. I think that we, looking out to the closing out of FY24 as well as FY25, if we're talking about own brands, double-digit growth in own brands is something that we are looking forward to, and I do believe we can deliver on that front. The monsoon, yes, it was erratic, but I must say that it did not have a big impact on us. Sula's consumers at this point are very much urban. I would say that 95% of our consumption is, you're talking about metros, tier 1, tier 2 cities. And even in that, metros is really something like 75% of our consumption. Having said that, there's been tremendous, terrific growth in the non-metro areas. So our largest selling growing states this year have been Punjab. Chandigarh has shown some great growth for us. CSD is our single largest growing consumer, you can say. So, the erratic strong closeout of FY24 as well as FY25.
You have a dominant market share in the entire wine industry. But now that a lot of small brands are also becoming big, there is a unique way in which now advertising is moving on. What is the plan in place to command and retain your ownership, as in your market share?
So, Nikunj, I must say that in the last 3 or 4 months, the news has been really good for us in that we have, in fact, expanded our market share. At this point, it is not a priority, I must say, for us as a company to expand our market share further. It is a priority for us to get more Indians drinking lovely Indian wine. You know, Indian wine is getting better and better all the time. It's a great value alcobev. It's a low alcohol alcobev, you know, that gives it an edge in many ways. So we want to penetrate further into this great country with our wines. And we want to get more Indians drinking wine rather than spirits. That's really our challenge. Sula's market share has reached really probably an all-time high in Q3. We are not looking to push that further at this point.
My immediate follow-up question is that, well, Indian wines are growing. They are different in terms of experience, the wine vintage, the profile, the quality, everything is different. But for a buyer, right now, the option to buy imported wine is something which is limiting largely because of the tax regime what we have. What happens when the economy will open up, when FTAs would be signed? Do you envisage serious competition which could come purely from global dumping of cheap wines? I'm using that phrase again. Global dumping of cheap wines which are available for $2, $3, $5, at least in big wine producing countries.
So I must point out that today we actually have a lot of imported wines already available in India at very competitive prices. So if you look at a state like Haryana, for instance, imported wine prices are the same as Sula's expensive wines. And despite that, I'm very pleased to say that we are holding up very well. There's a lot of pride in drinking good Indian wine as well. There will always be that segment of consumers who prefer imported wine, and that's no problem because there's more and more people coming on board, drinking wine, young audience who are very proud of the Indian story, of the Sula story. And remember that our wines are pretty fresh. A lot of the imported wine stock that you have still in India, you know, you might are 2 years, 3 years old. You're never sure what you're going to get in the bottle. So I'm very pleased to say, even in places where imported wines today are squarely in the same price segment as not even our most expensive wines, but say our Source series or our Dindori series, you know, our best-selling red wine, Dindori Reserve Shiraz, we are holding our own and gaining market share.
Good to have you on board, and cheers to that, I should say. Thank you very much for sharing with us those insights. And of course, a little bit of probing was necessary. So yes, we did pry and ask quite a few questions beyond what you would have expected, but thanks nonetheless.
Always. I appreciate it. And I welcome you to our vineyards next time.
Oh, we will definitely take you up on that offer. Can't wait to visit. Thank you for joining in. All right, it's time for a very quick break right here on the show. 576, that's where Sula is currently at. But the market's flat as ever. It's the mid-cap index up 0.5%. We'll be right back.